There are going to be huge knock-on effects on credit because there's been huge knock-on effects on credit on the tightening side since QE started, and especially since QE has started to buy credit assets and not only government or risk-free type of assets. Okay, so the knock-on effects will be around portfolio rotation and making credit potentially more expensive from a yield standpoint, and thirdly, creating some volatility in the risk-free rate market if the unwind of the QE program is not properly managed, in which case that could trigger bouts of volatility in the overall fixed income market. The way we're positioned is number one, we're avoiding rates exposure, risk-free rates exposure in our portfolio. Number two, we have very little deployment. Currently, we have 75% gross exposure, 25% net exposure, and duration adjusted, we're flat. Okay? And thirdly, we're focusing on stories where any idiosyncratic stories where any volatility around credit spreads and fixed income markets will not be too detrimental to the story. We are concerned, and we hope it will create volatility because then we'll have opportunities, and then our current positioning, we take advantage of it. Spreads can't go much tighter in certain subsets of the credit markets. Okay? Take investment grade. Okay? Spreads are very close to historical tights. Okay? And we had that, and we would argue that it's in bubble territory. Okay? And those are the shorts of tomorrow. Not because we believe that some investment grade companies will go bankrupt or will go bust or whatever, okay, or will face liquidity crisis. Simply because valuations are way too tight. Spreads are tight, but we think that you still have dispersion, and therefore you can still have some long, which makes sense from a valuation as well as an idiosyncratic catalyst momentum standpoint, right? And those are the longs that we have in the portfolio. And finally, in financial institutions, in banks, we think that there are still some value, but we've really reduced our allocation to hybrid capital for European banks, even if we still like the sectors, precisely because of valuation reasons. In European banks, we are really focused on some high-quality banks, not necessarily in core geographies. So we might go to Italy, we might go to Spain. We don't invest into the speculative names unless there are some high convictions that we have on realization of catalyst. UniCredit, take this example, used to be what I would call a speculative name. It's not anymore. When we invested a little bit, it was a speculative name in their hybrid capital because there was no certainty of balance sheet deleveraging, capital raising, starting to turn around the operations, etc. Now, the story has played out as we were expecting, and now we've exited. But overall, our portfolio had up to 20% of allocation to the financial sector, 20-25 between some old-style hybrid instrument, new-style hybrid instrument, and some senior debt. And we've reduced it, and we're now currently around 10%.